Hello, and welcome to another edition of Market Insights. My name is Evan Coffey, investment analyst here at GVA. And as always, I'm joined by Eric Parnell, GVA's chief market strategist. Eric, we're down the shore here at our latest Philly forum. And I want to start things off today with something that I feel like has been quite a frequent for us here on Market Insights. And that's concentration within equity markets. Outside of some consolidation that we've seen over the last few trading days, honestly, not today, as I've looked at markets this morning, but Monday of this week, Friday of last week, equity markets have been on a tear to start these summer months. Since April 1st, all three major indices are up more than 10%. We've got the NASDAQ leading the way at about 17, 18%. Since that period of time. And I think that the major catalyst has been, we've seen a slowdown in the conflict in the Middle East. We've, heard a variety of talks about peace, the opening of the Strait of Hormuz, which should obviously help, inflation woes and inflation expectations moving forward. But it shouldn't be discredited that by mid-May, 97% of S&P 500 companies had reported, and 85% of those had topped their earnings estimates. That's well above the 5-year average of 78%. Surface level, this sounds great, but as I mentioned before, while this recovery is healthy since the start of the conflict, we're seeing this AI trade and this AI freight train rolling again. I'm not going to, use the same line that I feel like we've been using, which is, hey, 30 to 40% of the market is in those top 10 names. I feel like that's at this point a bit of an overused stat. But something that we've talked about earlier today, we've talked about quite a bit back at the office, is more specifically, I think where the concentration lies is in industry. And right now, specifically semiconductors and that chip space. So something that I found interesting was, NVIDIA currently at a market cap of 5.2 trillion. Taiwan Semi and Broadcom each at 2 trillion. Micron and SK Hynix each have crossed the $1 trillion mark. That's just 6 names within this space. We could get into memory and names like Micron and SanDisk and the absolute tear, parabolic tear that they've been on. So at this point, these names aren't just a sector. They're not just in the industry. They're the market. So, like I said, we've had some contraction the end of last week that I think was healthy, beginning of this week. But, Tuesday, Wednesday, we're back at it. The NASDAQ is up. These names are up. So my question to you, and where I would love to hear your thoughts on, is the current state of equity markets, how you feel about it, and whether you think that this will be sustained or will kind of return to that first quarter era of breadth widening that felt healthier than where we're at right now.
No, it's a great question, Evan. And when it comes to the markets, there's a lot to be excited about right now. You mentioned corporate earnings growth and 85% of companies beating expectations. That's one of the things that really stands out in terms of our looking at markets, is that you look at the fundamentals. We got GDP growth that's projected to grow at 3% for the second quarter, which is strong economic growth, particularly for an economy the size of the United States. Inflation expectations remain fully in check. And you think about the primary driver of stock price performance over time, and it's corporate earnings growth. And we're projected to come in at north of 20% year over year earnings growth in the S&P 500. It's that type of growth that justifies higher stock prices. So, the fundamental backdrop is positive. Another factor too that we're really encouraged by is the broadening of the market. One of the things that we had seen from Halloween all the way up to the end of February, right before the outbreak of the Iran conflict, was a meaningful broadening in performance within the S&P 500. In 2024 and 2025, less than 30% of stocks in the S&P 500 were outperforming the S&P, which is much more concentrated than the 49% that you see in the historical average. Well, since Halloween, it was the total reverse. We saw this massive broadening. 66% of stocks were outperforming the S&P 500 year to date through the end of February, but then the Iran conflict started. We started to see concentration, and then the market bottoms on March 30th, and then everything just compressed on itself. It was back to the AI trade. April and May, market became very concentrated again with this huge AI boom that took place in the spring. Well, what have we seen during the month of June? We've seen that broadening again. We went from 31% of stocks outperforming the S&P 500 year to date at the end of May to 46% of stocks outperforming the S&P 500 as we close in on the end of June. That's very positive, because what that means is that that narrowing of performance that we saw from the beginning of March through the end of May, that's likely the anomaly, that we're going to continue more towards that broadening trend. And the reason that's important in a strong earnings growth environment is it means that the gains that we've seen in the market, despite the volatility, is sustainable. Now, there's one caveat to all of this to say it's a meaningful downside risk that we need to watch, and it's a key point that you're also alluding to. Some of the biggest names in the stock market right now, they are all connected to the semiconductor industry. And the chip sector, semiconductors, have done phenomenally well for good reason, because they're all tied into this AI boom. But we can't forget, much like biotech stocks, semiconductor stocks are notoriously volatile because they're effectively a commodity for all intents and purposes. And when you have a sector or an industry like semiconductors that have grown to become nearly 20% of the S&P 500 in a sector that is highly volatile and goes through boom-bust cycles, we need to be cautious about how things continue to unfold in that area of the market. Because if we start to see any type of slowdown in growth in that area of the market, things could start to come down pretty fast.
Yeah, and I think that is a good downside protector to keep in mind. And it sounds like from your perspective, we are headed on the right trajectory as it relates to breadth within equity markets. I want to take a step back, address the macro environment. We seem to be wrapping up the situation in the Middle East. Obviously, it's going to continue to evolve, continue to be dynamic, but we see Brent crude come back to those kind of incursion levels in and around $75 a barrel as of yesterday. If this holds and we get a formal peace deal, Strait of Hormuz opens back up, like I mentioned earlier within this segment, inflation expectations should start to mediate. They should start to come down. And with that, then, downstream, the end consumer should start to see less of a hurt, at the pump. Why is this important right now? Well, last week, we had new Fed Chair Kevin Warsh, kind of hold his first FOMC meeting, where the committee decided unanimously to keep the federal funds rate at 3.5 to 3.75%. The interesting takeaway from me from that meeting was not that, but it was that 9 out of 18 Fed governors now expect us to have at least one hike by the end of the year. This is a drastic flip from March, where the median still implied a cut at that point in time. But if we analyze the Fed's dual mandate, we see that economic activity and the labor market are strong on the surface. 172,000 non-farm payrolls in May and a steady unemployment rate at 4.3%. That signals that we should be more focused on the other side of the dual mandate, which is price stability. CPI accelerated in the month of May to 4.2% year over year. That's headline, but if we strip out those volatile, especially right now, energy and food sectors, and look at core, it was much more mild at 2.9%. Still accelerating, but much more mild. So as an economist, as our chief market strategist, where do you see the macro situation evolving? And more specifically, through the end of the year, are we going to see multiple hikes from the Fed?
Yeah, no, it's interesting how the perspective from a monetary policy point of view has changed since the beginning of the year. We came into the year, we thought we were going to potentially get rate cuts this year, and now the conversation has rightly shifted to rate hikes. I'll share from this chief market strategist perspective, I'm not sure that we ever needed rate cuts to begin with, because there is no shortage of liquidity in capital markets right now. And we have seen some meaningful inflation pressures. One of the things that we should expect is the headline numbers, some of those monthly economic data that come out from BLS and the Bureau of Economic Analysis. With oil prices coming down along with some base effects, those inflation readings should ease up a little bit. But nonetheless, pricing pressures are biased towards higher inflation over the next year. I think what's been impressive about the market is that although it expected rate cuts coming into the year, and now we're looking ahead to rate hikes, the market has really taken it in stride. And I think that's a testament to the strong fundamental backdrop that we have. And I think it's also testament to the abundance of liquidity that continues to be in the marketplace. The fact that we can be looking at anywhere between 1 to 3 rate hikes between now and the next summer And the market is working through that and continuing to be able to push through to the upside. Not only on the headline S&P 500 basis, you take a look at the equal weighted S&P 500, you take a look at mid caps, you take a look at small caps, they're all pushing towards new all-time highs, basically suggesting that the market sees that reality and they're working right through it.
Yeah, and I think that it is important to note that as of now, that July meeting, 34, 35 days away, still an expectation that they're going to hold where they're at. It's not until September where the probability shifts to a hike. So we'll certainly keep an eye on that. I'm going to round things out today with something that has certainly been top of mind for many advisors, us, their end clients, really everyone within the financial landscape, and that is the IPO market. It's certainly been buzzing this year. We've seen a revitalization like no other, with SpaceX being the dominant driver thus far. It completed the biggest IPO in history on June 12th, raising $75 billion, but with underwriting allotments and a growing market cap, that number's more like $85 billion. Options trading opened up, the following Tuesday, and we see an immense amount of volatility, just between these lockup windows, the float of shares, and as I mentioned, short maturity options being traded. Layer in, just overall investor sentiment around Elon Musk and SpaceX as a whole, and we're bound to see continued volatility. Currently, shares are trading in and around $160 a share, but have swung broadly. Between that IPO price of $135 a share, and it got above $200. So moving further, kind of past SpaceX, more broadly to other major IPOs, we're likely to see Anthropic, OpenAI, and the founder and overall parent of ChatGPT, Anduril, the defense company, Canva, the software company. What does this signal to you? And this this IPO buzz, what does this signal to you about where we're at as a market? And what is your message? Maybe more importantly, what I would want to hit on is, what is your message to advisors who have clients that come to them and say, hey, why am I not in SpaceX? Why am I not in this next best shiny object? Mm-hmm. What is the behavioral side of this that you would like to, kind of address to the broader financial landscape?
Yeah, no, it is a great question. It's something that I think we're all going to be evaluating over the next 12 to 18 months at least. There are a lot of really exciting companies that are out there in the AI space and other spaces as well, but the AI space is really capturing a lot of the investor attentions, as well as space technologies. Be careful when you're thinking about allocating to new IPOs. There's a lot of great companies out there, but that doesn't necessarily mean that they're going to be great stocks. And for those that have experienced past IPO booms, like in the late 1990s and the early 2000s, remember the Facebook IPO in 2012, there's a lot of unpredictability that goes with stock trading after an IPO. And that will continue for the first 6, 12 to 18 months after an IPO for all of the different machinations that you implied. It's not like the stock just goes out there and is traded freely. There's all kinds of machinations that are associated with an IPO, even after the stock is publicly traded. So it can be very tempting to see, a new shiny object coming to the marketplace, or to say, hey, that small company that I could go out in the small cap marketplace and buy and own them all the way to becoming a mega cap company. Well, with the advent of private equity and the proliferation of private equity, those days are, they don't exist right now. I mean, companies are IPOing as large cap, mega cap companies with their transformational technology and years worth of performance history, but they still have to go through the IPO process. And even if there's exceptions to the rules, one always has to keep in the back of their mind, is this a good thing that we're making exceptions to the rules, or could that lead to unintended consequences itself? It may be tempting to allocate to these types of opportunities, but be careful out there, because they come with a lot of volatility.
Yeah, and I think that is a great message for both advisors and their end clients, because it is certainly an evolving, situation that they're dealing with in terms of IPOs and this kind of latest craze with them. Eric, it's great to spend time talking markets with you. As I said, we've got an evolving equity landscape that had been favoring the biggest names. As you mentioned, we're starting to see some breadth once again, but I think that more than anything, what I gathered from your comments is, to just continue to remain diversified, going to trust the process in terms of diversification. We'll continue to monitor how the Fed manages inflation and the situation in the Middle East, and of course, keep our eye on the IPO front. And to our audience, thank you for joining us for another edition of Market Insights, and we look forward to seeing you again soon.